Okay, welcome to today's chat about interest rates. I'll be pausing to kind of be the show coordinator here and facilitator, letting people in and so on. So excuse my distractions. Today is September 8th, 2022. And the topic for the day is planning for higher interest rates, which is a very timely topic for sure. And my name's Peter Johnson, and I've been doing financial planning for 40 some years. And we have a special guest today, Dave Warder, who is a pretty experienced mortgage broker and helper of all things getting loans for real estate. Dave, I can't believe you've been in the business for 20 years because you look like, you just got out of college or something. But why don't you feel free to say something about yourself?
Yeah, well, I've been doing this a long time because I started early, and it was really the only career that I've had thus far. So I am 45 years old, so I have been doing it for 20 plus years. I started with my dad back in '98. Helped him set up he was a mortgage broker, sole proprietor, helped him build his business. And then I went to work for Washington Mutual in 2005, doing multifamily commercial loans. I did that for about 12 years, and then just, realized after the Chase takeover, that wasn't going to be something I wanted to do long-term. So I got back into single family in 2018. So help a wide range of clients, from, first-time home buyers to people who are looking to buy investment property just because of my background. I do a lot of the 1 to 4 non-owner. A lot of my past commercial clients, they have challenges sometimes getting loans in the new environment with Dodd-Frank, and just we're underwriting with more scrutiny than we were before. So it's been a great journey, and I do really like what I do. So
awesome. If all you folks out there want to mute yourself so that if sound comes up in your environment, it won't be shared unless you want it to be. So thank you. Something I wanted to ask you, Dave. I wanted to mention that Dave's business card and so on says that he's in Southern California, but he's actually here in the Bay Area.
Yeah, thank you for clarifying. Yeah, Provident is out of Southern California, but I work up here in Northern California.
Awesome. Well, thank you for being here today. My plan of attack is to go through some of the basics of economics and interest rates and how the Fed works and where we are, providing a little macro background, and then have Dave talk about some of the particulars of mortgage strategies, what's going on in the markets today, the products, and any observations he has. We'll talk about the impact on housing prices as well, and maybe even talk about where interest rates may be headed, although in this world of constant change, it's very, very hard to predict. It's always been that way. So without further ado, try to go through my slides fairly quickly. I don't want to bore you with them, but I'm kind of a data geek and love these different updates, charts, data that you can get these days that's, so insightful and current. So we're going to go over here. Oop, there we go. So today is good timing on having this conversation because the 30-year mortgage rate just hit its highest level since 2008. So it was dipping down a little bit in the last couple of months, but we're back up. And this is a little chart showing right through today. So it may not seem like 3% is a lot of change in interest rates, but we're starting from such a low base that it really represents more than a doubling of rates, which is incredible. And with compounding and all of that, it really adds up when the impact on investment markets and even the housing market. So why are interest rates rising? I think everybody has some sense of that. It's really the Federal Reserve that's behind it. They control interest rates through the supply of money, and the more money there is, the cheaper it is. And when they start to withdraw money, then the more expensive money becomes, and interest rates basically are the price of money at any given time. So not all central banks are the same, but the US Federal Reserve is aiming for a dual mandate, two different objectives, which really are at odds with each other. Number one, we're looking for maximum employment. We want the economy to be humming along and people to be able to get jobs. So this would be something, if they wanted more people working, they would stimulate the economy by putting money into it and lowering interest rates. That stimulates economic activity and hiring. On the other hand, we really don't want inflation. So if they print too much money, or if the economy gets overheated, then it can result in inflation. Remember, inflation is too much money chasing too few goods, and inflation hurts everybody, devalues the money that we already have. So they're looking to tamp down inflation, and they do that through raising interest rates and slowing the economy down and reducing the expectations for the demand for money as well. So on the one hand, let's get people to work, let's put money out there, so we're stimulating things. On the other hand, whoops, it can get overheated and cause some problems. We really don't want inflation. They want a little bit of inflation, but not too much. So they're aiming for about 2%. And that's it. They do it by influencing the supply of money and interest rates, which are intimately linked. So where are we now? Right now, we're at a very low unemployment rate. We're back down to where we were before the pandemic hit. It spiked high and fast back in March of 2000, but it has come back down. So, hey, we're doing great with the unemployment rate. But whoops, that stimulus that they put into the economy over the last couple of years has finally started to produce inflation. They've been pretty stimulative at the Fed for a few years, and it hasn't produced inflation until now, but we have so many factors that are changing with the pandemic, supply chains, all the stimulus that all the governments have put into the markets, and people kind of returning to a normal work life. By the way, David, you have anything you want to add as I go along? Please feel free.
I will, thanks.
All right, so yeah, this is pretty high inflation rate that we just hit. Back in the late 70s was the last time we had any kind of inflation that was worrisome. So it's very unusual. I'll give away my age by saying that I've been around through all of this. I started in the business in 1980 and worked at a place where high interest rates were a plus for us. So where are interest rates right now? Well, if we look back a year or two ago, 2 years ago, we were looking at this, what we call the yield curve. We were looking at that yield curve 2 years ago. So the 1 month Treasury bill was paying something close to zero, and that was true across the timeline for maturities. Good morning. Libby, if you would mute yourself, then
Sure.
you can come on later and ask questions if you want. So interest rates were very, very low across the maturity spectrum. These are Treasury bills, Treasury notes, Treasury bonds, all the same thing, just depending, they have different names for them depending on how long it is till they mature. So these longer ones paid a little more, but even on a 30-year bond, you're only able to get 1.5%. That was 2 years ago. And then a year ago, we'd started to see things change. The Fed had not moved. They usually operate in the short term. I'll talk about that in a second. But the market was expecting higher rates to come as we went along. So a year ago, that's where we were. And today, here's where we are. So again, the difference is startling in relative terms. In absolute terms, having a yield curve around 2.5 to 3.5 is not excessive, but you can see something's been going on. And that is what we've had. Fed operations, their normal operations are in the very short term interest rates. They do this by lending money to banks. It's called the federal funds rate. It's the overnight rate. That's where they do most of their operations. So they're manipulating the price of money that banks borrow at, which is reflected pretty quickly in lending and affects the economy quickly. So they've had a hand in raising these short-term rates because they operate as a big player in that area. Oh my goodness. So I guess we're going to skip over a slide. Yep. What they've been doing in the last 10 years or so is quantitative easing, which is a fancy term for manipulating rates beyond the overnight rate and into direct buying of treasuries and mortgage securities that have longer maturities. So the Fed has had a hand in letting these rates rise as well. So it's unusual for them to operate in this part of the yield curve in these longer term bonds, buying and selling them. But they've been doing that because they were running out of tools. The overnight rate wasn't enough to control things. So they intervened in the markets across the yield curve, the different maturities.
Here, I just had a question, what you think like the long-term effects of the quantitative easing might be, because like you said, that is a relatively new tactic that they've been employing. So some people are a little skeptical of it and how it's going to play out, I guess.
Yeah, we'll have more to say about it as we go.
Sure.
I look at it as basically the same thing as their normal market operations, which are the overnight trades. Both of them, if they're buying securities, they're putting money into the system, and that's stimulative. And both of them, if they're selling securities, they're soaking up money from the system. And overnight rates take a while to filter out into the economy and into other segments of the bond market, both in terms of the types of bonds and the maturities. I'm getting a little technical here. I want to assure people we'll get back to solid ground in a moment and try to have one foot on solid ground anyway, and not to be too theoretical. But it's either stimulative or it's restrictive. And because quantitative easing was unusual, people are still rather skeptical about it. I don't think it's anything strange. It is too bad we have to resort to stronger measures and more measures, but it's a natural extension, I think, of their overnight work. And I don't even know why they call it quantitative easing. It's really the same thing they've been doing, like I said, in overnight rates for a long time. And
Yeah,
it is
didn't the
extremely
quantitative easing start back in 2009 or 10, right after the crash, the credit crash?
That's exactly right.
Mhm.
Exactly right. And yeah, you guys in the listening audience out there are free to drop in and ask questions if you like. So thank you, Josh. Yeah, this is relatively new, so people are still getting comfortable with it. This is the overnight rate, and you can see it got down to unprecedented levels there in 2008. And that's when they said, hey, we need something else. And we started doing quantitative easing as well. And I think we'll have a chart on the Fed fund or the Fed balance sheet, which shows how much they've been doing. So we have quantitative easing, which helps stimulate the economy by lowering interest rates, making money cheaper. But now we have quantitative tightening, QT. We have new acronyms for everything. And quantitative tightening is just the opposite. They're selling off bonds to soak up money in these longer maturities. They're doing it pretty darn fast. They are selling off bonds at a heck of a clip. The total for every month is $95 billion worth of bonds being sold. They're selling off treasuries at 60 billion a month and mortgage securities 35 billion a month. So this third item here, middle item, where they're selling mortgage-backed securities, they are raising interest rates directly in the mortgage market this way. So there's a lot going on, and we don't hear about this quantitative tightening as much. We only hear about the Fed funds rate, but this is also very important. The Fed's portfolio has built up to $9 trillion. So even at 100 billion a month, it's going to take a while to get over this. So what we're saying is the Fed is seeing an overheating economy and inflation. They take it very seriously, and they've turned 180 degrees from being stimulative to tightening and raising rates. So really the Fed is behind it. In fact, here is the Fed balance sheet, which indicates the bonds they hold in their portfolio, now up to 9 trillion. Up to 2008, we only had 1 trillion. Yeah, 900 million. Anyway, too many zeros. You can see they doubled their balance sheet back here in the great financial crisis. We thought that was something, but that's just been dwarfed by the recent increases. When the pandemic hit, they went hog wild, really worried about the economy collapsing. One other thing about this is every time they start to try to taper off in the last few years, taper off the purchase of bonds and start to raise rates, the markets have reacted very negatively. So they've pulled back from every one of those initiatives so far. But they're definitely serious about it this time, even though we've only begun to pull back on their holdings. So this is going on all over the world. This is not just a US phenomenon. If it were, it wouldn't be as important. But central banks across the world have been, as you can see in this column, last move. It's a column of red with very little green. All those countries have been hiking rates recently, and there's some more news today about that. So that's just going to have an amplified effect on what our Fed is doing. Okay, a little bit of not really predicting, but some forecasts are showing that inflation may taper off. We had a good reading on that today. The month-to-month inflation rate fell from about 1%, which would be 10% plus a year, down to almost zero for the last month. So hopefully inflation's already being reined in, but in general, the markets expect it to decline. So this might be good news. The Fed's tightening rates now, but they may not have any reason to in a year or so. So we'll be looking for that. This is another way of looking at these expected inflation rates. Been a while since I gathered these charts, but the idea is that rates may be coming down. So this is the CPI, and it's interesting that it's already showing it coming down. I think it's trying to project out a year, so we're not actually there yet. Well, this is another forward look into the market. This is what investors are willing to pay for inflation protection when they purchase Treasury inflation protected bonds. It's kind of hard to get how this is calculated and why it's important, but it is the market's opinion, if you will, on where inflation is going when people are buying these 10-year TIPS or Treasury inflation protected securities. Apparently, bond investors are not expecting rampant inflation out here because they really are not asking for much more return in terms of inflation return on these bonds. There's two parts to the return. So the market is voting, if you will, or saying, hey, we really don't expect horrible inflation, which is really interesting because we have seen inflation a lot higher than 2 or 3%. It's market here is saying we expect 2.5% over the next 10 years. So another data point. The 30-year mortgage rate is where we come down to where the rubber meets the road in our conversation today about real estate. And that has been falling since 1980 when Paul Volcker just squashed inflation. It's very effective by letting rates go up to where they would. So interest rates on mortgages rose to almost 20% back then. And they fell to almost 2.5% during this pandemic. And now we're back up over 5. So as I said earlier, the rates have more than doubled, which is significant coming off a low base, especially.
I think how quickly it happened as well, Peter. Yeah, that was a significant thing that hit our markets really quickly and kind of rocked the mortgage industry for a while, just because we'd never seen the increase that much that quickly. So it had an impact. So we'll kind of see moving forward how they go. I mean, I keep using the word normalize because that's, if you look at that chart, that's what rates are doing, but it's never happened that quickly.
Now, these are historic times in so many ways. And that speed of increase has sort of shocked people into action and inaction, I suppose.
Yes.
But it has slowed down the mortgage business for sure. It's like people are saying, oh my gosh, expensive. This is over the last 5 years. So this one's a 50-year chart. In the last 5 years, we're looking at this. It's almost hard to remember that rates were as high as 5% just a few years ago. Here's the recession, the gray area, when the pandemic hit. Believe it or not, we're not in a recession yet, or we don't know that we are, if we are, because the data lags reality. But rates going down a little bit and going back up here this year. The impact on home buyers, this is really David's territory here, but I had this nice chart. The impact on home buyers is if interest rates are higher, your mortgage payment goes up, even if the price of the house does not go up. So it becomes harder for people to afford payments. And you can see they've really risen a lot in all 4 segments of the US here. The Northeast, the West, the South, the Midwest. And it looks like we've gone from, say, $800 a month for national average in the expensive zones, up to $3,000. I mean, that's amazing. And all of these zones have picked up. So, okay, I can't afford as good a house. I'm going to offer less on houses. There's going to be fewer buyers able to support high house prices. So this trickles over to house prices and knocks them down to some extent, or else slows down their increases. This is from CoreLogic, which is a real estate tracking company. I don't know if they do other economic stuff, but they do the real estate. And they give odds of home prices dropping over the coming year. The Bay Area definitely is one of the areas that has run up so much and has such high prices compared to income that we may not be able to support the high home prices we've had. Numbers I've seen would be, if we do fall here, something probably 5 to 10%. I don't know what you've seen, Dave. We're not.
We saw a slow summer, which typically summer is when buyers are out looking for properties. But from the realtors that I'm having conversations with, I guess things in August have picked up a little bit. They've seen more activity at open houses with buyers coming back out in the market, maybe where they're kind of realizing that rates have normalized. If I do want to purchase a home, this is probably where the rates are going to be at. We don't see them, coming down significantly in the near future. So just sort of getting used to these higher rates. And then the issue with our market too is the inventory. I'm sure we will see some softening in the coming months and next year potentially, but and there could be a large change where all of a sudden there's a influx of houses that are available on the market for purchase. But the inventory is always kind of the elephant in the room for us too, even as things change.
Yeah, good old supply and demand, and we've got a lot of conversations going on about policy and affordable housing and building more and building higher and all of that. Home prices have taken a little bit of a dip across the country, but nothing spectacular. You can see back in 2008, we had drops of 10 to 15% nationally. That's probably what we would expect, is a little bit of a tapering or perhaps a little bit of a drop in prices. I don't think it's going to be huge across the country. And this is another area for you, Dave, is the problem was exacerbated in 2008 because there'd been a lot of lending to buyers who were not really able to cover payments. The lending standards dropped so much, but one of the things that will help protect us from just a lot of dominoes falling is people are being vetted more carefully for loans, and we don't expect as many defaults.
Yeah, I agree with that 100%. And much to the chagrin of some of my clients who are, applying for loans, and we ask for quite a bit of documentation, and we're really careful about making sure the buyer has the ability to repay. And they're very much more conservative. I mean, that doesn't really paint the picture of what we were doing back in, before the crash of 08 and 09. That was just, irresponsible, where now it's a much different thing. So, it's that should help the housing market in the coming months and into next year, with the changes that might be happening.
Yeah, it got really, really liberal. Probably the proximal cause of the housing crisis and credit crisis back then. So there are other factors affecting home prices, and one of them would be population growth and demand, which is this chart down here. We're almost at zero population growth. This goes back to 1960 here, but it's been dropping and dropping, and now we have a lower life expectancy than we did. Was there anything you'd like to say about, I had a question yesterday about corporate home buyers and their influence on the market. I did a little research on that. Climate change is affecting prices in some areas as people sometimes find it hard to get insurance against floods and fires. And some areas may be inundated with water if things proceed the way they're going. So anything on these other factors, Dave, that you'd like to comment on?
I mean, the corporate home buying, not exactly sure what you're referring to there, but yeah, I mean, there are forces out there when a borrower who's facing much higher interest rate is coming in against a cash offer, or, it just makes it really difficult to compete. So, there's definitely an advantage there with an all cash buyer versus someone who's financing.
I've read that something like 1/4 of home sales in the last year or two have been these big institutional buyers. People are concerned that corporations and institutional buyers like BlackRock and others are really taking advantage of small buyers and raising rents faster than other people would, and adding costs and not much value to the home equation. So
it's a
I thought it was
concern. Yeah,
interesting.
it definitely goes against, the American dream, if you will, which is always what I bought into, when I was younger and got into this business and was told I wouldn't be able to buy a house in Northern California because, that's a little bit scary to think about, that whole aspect of the equation. That's definitely part of real estate right now.
Well, I was going to say a couple minutes ago that as money gets easier, interest rates go down, it causes people to take more risks and to engage in behaviors that may not be sustainable. Warren Buffett said, when the tide goes out, you find out who's been swimming without a suit on. So when money starts to dry up, not only do people pull back from buying, but corporations do too. They might wind up with some large losses if they've gotten carried away with this, but they do have access to that cash and the cash buying, which puts them at something of an advantage. But ultimately, who are they going to sell to? Or are they just going to keep it and raise rents, which have been going up? And I haven't got a chart for that, unfortunately. I think climate change probably hasn't started to affect real estate prices that much yet, but obviously that's going to be on people's minds as they make these investments with 10, 20, 30-year horizons. Are they going to build in parts of New York City or New Orleans or anywhere that's low-lying? Florida, the whole state.
Well, California and the fire issue. I mean, I shared with you my current situation. I do live in the mountains and we're on the California FAIR Plan. So, that was $6,000 just for the FAIR Plan. It was a tripling of our insurance, because of where we chose to live. It's part of it. But I've talked to a lot of insurance agents since then, and everyone in California is going to start to feel that the cost to insure your home is just going to increase. And so that's a challenge for people who already own, and then people who are trying to get in the market. It makes it more difficult when your insurance is a lot more expensive.
And some areas the insurance companies have been pulling out of entirely, I understand.
Yeah.
I don't know how that is going to fit with people having to have insurance policies to get a mortgage. If they drop your insurance coverage and nobody else picks it up, and you've got an outstanding mortgage with a commitment to maintain fire insurance, I don't know how that plays out,
Yeah, well, I mean, that's where the FAIR Plan comes in. That's unfortunately what we're on. I made like 30 calls to insurance agents trying to avoid the FAIR Plan, but that's what we had to use. So that's the safety net for now. We'll see how that plays out.
And I understand that something like 40% of homes in the US or more are in areas that may be affected by fire, which is an interesting number. I would have thought it would be lower, but it's pretty substantial.
Yeah, I'm not sure. I haven't heard that number, but if it is, yeah, it sounds incredibly high to me as well.
Well, maybe it's because fires are jumping and burning neighborhoods that aren't even right next to forested or areas of wilderness where fires just run. I don't know. And then we have water issues. So it's becoming complex, but I'm really grateful that I live in an area that has pretty solid power. We're not that close to fire risk. And yet we're located where we have a good economy and we can get our needs met pretty well. But you have to really think about it and where it's getting hotter for sure, but this is not, this area here in the South Bay in California is nothing like Arizona, for example, where they are starting at our highs and going from there. But all those things are going to have to do with house prices in the future and demand and supply. I've got other questions for you, Dave, and there may be other things that you wanted to bring up. So let me just open up the floor to you on that. And we do want to take some questions too.
Sure, yeah. Oh, sorry, Peter, you said you had questions for me?
I do, but I wondered if there's anything that is on your mind that's, that you wanted to make sure we got in today.
No, I mean, I think you covered most of the things as far as the interest rates and where they are. And then, it's good to look at it historically, where they've been. So, because we just got so used to the Fed keeping them artificially low, and then they painted themselves in a corner, and then they jumped up so fast, and the market's, still kind of reeling from that, and people are wrapping their head around this sort of like what I like to say of the normalization of interest rates. And I wish we would get some more consistent information out of the Fed. I think, sometimes they act with confidence and the markets respond well to that. And, sometimes they don't. Like, they think they have a handle on inflation and then they don't. And so they're increasing interest rates to hopefully curtail the inflation. But then when they don't have a lot of confidence about what they're doing, the markets don't react all that well to it. So they raise the rate, and then the stock market acts poorly, and then the markets kind of shift and the rates soften up a little bit. So it's almost just like, maybe we just rip the Band-Aid off, let the rates go up, and then they'll hopefully naturally come back down. But some of this back and forth has just been challenging, especially for my industry. It's incredibly difficult to predict where things are going because most of our, the things that we use to predict where rates are going, it's so upside down and very challenging to do. So what I encourage people to do, no matter what they're doing, there still are some people out there who may need to access equity and refinance. It still happens. But, most of it is people who are thinking about purchasing. My advice is to get started right away. Do that pre-approval. If you do think you're going to purchase a home, do the pre-approval right away. It's funny how many people sit on the fence and then they all of a sudden, oh, there's this property, I really got to make an offer on it. Well, I don't have your application. I don't have your documentation. I can't help you. So that's one of the things that I always advise clients, just, get it done, get your application done, get your paperwork in, put yourself in the position where, you can take advantage if that property comes up that you really want to purchase, just to make sure that you're ready. So that's, a lot of the conversations I'm having right now, because I'm working with a lot of, pre-approval clients who are looking to purchase. And, sometimes they're still in that sit on the fence mentality, but getting started with a pre-approval just, gives you all the information that you need and puts you in a good position. So that's my advice to many of my clients right now.
I like the old quote of luck is where preparation meets opportunity.
Absolutely. Yes.
So we are talking about planning. It's in the title here.
Mhm.
There's a lot we can do that people don't do. I mean, we all, I guess, face different challenges every day, get distracted, get busy, and we don't prepare for the things that maybe we think are farther out in time, or they're not urgent, or the odds are not that great. But if we're honest with ourselves, there's a lot more we can do instead of just sitting around and worrying about things. We can have our options open. So I'm thinking about strategies for mortgage rates. And you told me something I didn't know a few weeks ago about lenders are not allowed to uh, restrict people from refinancing. So there can't be any refinancing penalties anymore. So if you, whatever rate you have, if you go ahead and get it, you're in the driver's seat. You can drop it, but nobody can raise it on you. You can keep it if that turns out to be a good strategy, or you could refinance and
Right.
drop
As
the
long as you
rate.
did the 30-year fixed rate, that no one's, so that's another thing that I can speak to because it's coming back. As always, as rates go up, we're going to see the adjustable rate mortgage come back. I mean, 30-year fixed have been so low for so long, it just didn't even really make sense for most people to look at them. Some people, they look at interest rates in a much different way. They look at, we're going to see, values go up all the time. So I want, I'll look at an adjustable, I'll look at an interest only, even some people do, because they don't want to pay down principal. That's one way that some people look at it. Most people, they look at it as, I want my monthly payment to be secure. I don't want it to go up and increase. And 30-year fixed were so low that was just the rate that everyone purchased on. It was the best term out there. Now, as rates are increasing, and some people are, they're trying to purchase a home, and it's very difficult for them. At the higher interest rates, they can do a 5-year fix, they can do a 7-year fixed. So they're taking that risk of, it's not locked in for 30 years for the entire term of the loan. It's locked in for 5 or 7, but hey, it gets me in to the home period, or it gets me into the home that I'm looking for. It's, it's more affordable at a lower interest rate. So yeah, on those 30-year fixed rates, they're locked in. You can refi whenever you want. As we move into these higher interest rate markets, we'll be seeing more of the 5 and 7-year fixed products, just as people are trying to get into the market and they need a lower interest rate.
Yeah. So in other words, you're saying if you think rates are going to drop at some point in the future, don't lock yourself in. And if you think they're going to rise in the future, do lock yourself in and get that rate if you're close to the bottom. But again, very hard to predict.
Yeah.
But two little indicators I think are pretty significant. One is, I'm actually relieved that the Fed has taken this hawkish tone. That's the term people use when they're being vigilant about inflation and aggressive in terms of keeping that down. Because they were dovish before, they were very stimulus prone and stimulative in their actions. And I like to see that flexibility and that adjustment based on what's actually happening, because we don't need somebody who's just attached to some ideal in their mind about how things should be and not flexible and not paying attention. I heard Fed Chairman Powell this morning. It was really interesting. He said, too often in the past, the Fed has loosened monetary policy before inflation was really under control. It's been a long time, but what he's saying is we're going to be really steadfast and keep fighting inflation until we're sure all the ashes and embers are out. So he's going to keep going for a while. They're going to keep raising rates. And all things equal, that's going to drive prices down in the bond market. It's going to drive prices down, all things equal, in the stock market, and it'll provide downward pressure on home prices too. And could mean that if you're only going to have a mortgage for a couple of years, at least I would probably look at not a variable rate at this point. But anyway, so
Yeah, nothing that I was
the Fed is,
advocating for, but it's what's happening right now in the markets that
yeah,
we're seeing more 5 and 7 year fixed out there. I mean, and we had that security blanket of the 30-year fixed for so long. I mean, 2 and 3% is free money, especially on a 30-year fixed. I mean, it just made sense for everyone to, to do that. And many people have taken advantage, and many people will hopefully, weather some of this storm with a very low interest rate and a manageable payment. It's the people that, like you said before, have overextended, or, the people that are trying to purchase right now. That's a little bit of a different story.
cool. And there's some government programs where they're trying to stimulate home access or buying access through, I've heard a couple of ads for zero down mortgages, and California has this program to help new buyers. Is there anything of interest for people who, let's say we have listeners whose kids might be interested in buying their first home, that you think would be significant in this market?
Yeah, those zero down are a much higher risk, especially for lenders. I mean, zero down when if it's your home and things change, it's an odd time to be going into 0% down when we've got, the housing market is actually starting to kind of level out, and maybe we'll see it soften or change the 5% possibility fluctuation that you were talking about. So yeah, we'll see how that plays out in the market if we do have an influx of 0% down, especially the government-backed ones. I do FHA and VA, and VA is actually a 0% down. And those are backed by government, so underwriters are more inclined to to write those loans because there's their insurance policy. I think we saw in 08 and 09, the government wasn't always great about coming in and giving the protection that they promised on those. But those two are solid though in the 20 plus years that I've been doing this. The FHA and the VA have been a pretty solid loan product, where I haven't done a lot of the 0% down.
All right. I'm distracted at the moment because somebody else logged into the Zoom account and it said that I'm logged out. So I don't know what that means exactly. I can still see you, so I think we're fine.
Yeah, we can still
and I
see
see
and hear you,
everybody
I
else
think, so.
logged in. Goodness sakes. Always fun with technology. I love it. And it's always a bit of a challenge. Let's see if I can go back to that. There we are. How about all y'all that are out there in listening land? Do you have any questions, suggestions, whatever? Could be about this particular topic or anything related to it. And you can just unmute yourselves to ask the question, and you're welcome to. We'll give a little while for people to think about that.
Peter and Dave, can I ask a question? This is Pat.
Absolutely, Pat. Welcome.
A friend told me she used to be in the real estate business, and she said that people, lenders do not want to do FHA loans. And I don't remember the details, but her kids were getting pre-qualified for an FHA, and she said she didn't want to tell them that it's not going to be accepted. So does anybody have any information on that? I'd never heard that before.
No, for the most part, the only issues that I've had with FHA is they have a stigma when you're purchasing a home. Sellers want, an over asking price offer with a 20% down, well-qualified client. And FHA kind of has a stigma of, oh, it's FHA, what if there's an issue? And it's kind of funny because those clients are usually well vetted, and the underwriter has already done a pre-approval for them, and it's a very high quality loan. I think sometimes there's a stigma of whether or not they're actually qualified or not, and whether they're going to be able to close. And the FHA does have, if you're purchasing a home with a septic and a well, they have special restrictions on there that it has to pass the septic and the well test, which are very basic things that a borrower should do no matter what. But in our market in the Bay Area, where it's so competitive, many borrowers are writing loans with no contingencies whatsoever, not a loan contingency, not an appraisal contingency, which drives me insane. I can't stand it, but it is the market that we're in. And, the realtors realize that there's probably going to be another offer where they didn't write a contingency, and it's highly competitive. So that's usually the issue with an FHA. It's not usually qualifying for them. It's just that we're in such a highly competitive market that those buyers are going to struggle. They might have to make multiple, offers on different properties before their offer is accepted. And hopefully with the market change, and softening up a little bit, that won't be the case as much. But FHA is a great product. I've helped lots of first-time home buyers with it. I like it. I used it, years and years ago when I was a first-time home buyer. So it's a good product. It's really just like I said before about getting yourself pre-approved, making sure that you can figure out what your budget is, and the only way to do that is to get pre-approved up front and see what the best options are going to be for your situation.
Okay, thank you.
Sure.
And as I mentioned at the outset, this will all be recorded, so y'all can check it out later when we post it to the website, or you can email me. Doesn't have my email address up here, but I am peter.johnson@pwjohnson.com. And also I'll send a copy of the slide deck to Dave so he can share it with anyone who emails him.
Yeah, I would definitely like a copy of that. Thank you.
It's been, in flux right up to the last minute with today's news. I was thinking about information resources. I really love bankrate.com as a place to go and get a sense of what rates are in a particular area, what different lenders are offering in terms of products, and also for savers, really great for checking out CD rates and whatnot. Are there other information resources that you recommend, Dave?
Well, it's funny. I think you and I have talked about Bankrate. I think Bankrate's, a good kind of just a measuring stick to test the waters, but they don't. I come across this all the time where someone will say, well, I Googled the interest rate and it should be, X, where what I provide for clients, I do a total cost analysis. So I can show 3 different interest rate options and the cost involved, where just a quick snapshot on, say, a bank rate, it's just going to show your interest rates. It's not going to be any cost. And they're going to show their lowest possible rate that they can, and not show the costs involved. So I do the cost analysis for people all the time. It's just something, people can ping me. I just had a realtor ping me this morning before the meeting, and I was just putting one out really quickly before we did this. She wanted to look at a 30-year term, a 7-year term, and I can show a breakdown with principal, interest, taxes, and insurance, and the costs involved with each rate. So it's a real, kind of a quote that you can use instead of just an interest rate. It's really tempting for people in my industry just to kind of throw out an interest rate, especially the lowest one that they can do. But I like to be more thorough in how that I do it. So I just do a cost analysis. Now, that's just an estimate. It's not, there's all these disclaimers that are like, hey, you're not underwritten. This is just a basic idea of, the rates and terms that you're asking for. We obviously have to take an application and underwrite you, but just being able to show people sort of the full picture of the full payment and the costs that are involved with, the rates and terms that we're quoting. So, but for the quick interest rate stuff, everybody's going to use Google and check rates and things like that. But, when you really want to get an actual quote, I have a great tool that I really like to use to share with people.
Of course.
Is anyone aware of the changes in bankrate.com? Because a few years ago, they seemed to switch to more of a commercial advertising model. And it made me a little distrustful of them because they seem so interested in trying to sell things on their website. And I did come across a situation where there was an institution which wasn't listed there. And it was quite a process for the institution to say, oh, we didn't know that. And then I don't know what Bankrate told them, but eventually they got listed. But it made me wonder if people are paying to get listed on bankrate.com. Has anybody heard anything about that?
Well, I'm going to assume that Bankrate is paying quite a lot of money for Google and those advertisers to put them up to at the top of the list. So that could very well trickle down into, hey, if you want to be on our list, you've got to, it wouldn't surprise me at all. Do I have any information that states that yes, that's going on? No, I do not. But it wouldn't surprise me. Like I say, I come across Bankrate, all the time with, well, Google said this, and it's like, well, when you actually apply, there's 6 different reasons why you didn't actually qualify for their best rate. Your credit score was 2 points too low, or your loan to value wasn't this or that. So it's just, I think it's just better to, talk with a mortgage advisor and get an actual quote. And you're really not going to know until that mortgage advisor looks at everything, looks at your income, your assets, your loan to value position, and your credit score. And Bankrate just can't do that with just a quick search.
I appreciate that input, Dave, but I'm not in the market to buy a home. I was looking at CD rates and stuff like that.
Oh, I see. Oh, I'm sorry. I was confused by
That's
that.
okay.
Yeah.
I didn't make that clear, but it just made me a little suspicious of what's going on there. So thank you for the input.
No,
Peter,
Pat, you always ask good questions, and that would apply both to CD rates and to mortgage rates. I would think that if
Yeah.
somebody's paying them, then they might be in the higher listed areas, like in Yelp, where it's hard to tell if you're looking at the sponsored people or well, there is a second site that I like to use, and it's definitely a little bit harder to navigate, but the Federal Reserve has a research site through the St. Louis branch. It's called FRED. Can't tell you what FRED stands for, but it's like the name Fred, F-R-E-D. And they have hundreds of thousands of different data series available. And it certainly is easy to find mortgage rates, the 30-year rate, 15-year rate, and see how they're changing over time. You can also find things about population and GDP and some more dollar trade weighted value versus other currencies. An awful lot of good stuff there. And if you want verification from a non-commercial site, maybe that could be another place to look for kind of a confirmation of what you're finding on commercial sites. But yeah, Dave, you've got me convinced to talk to a mortgage broker first, because actually each situation is different, and different lenders may have different kinds of clients that they work with and specialize with.
Peter?
So that would be good.
Peter,
Yeah.
this isn't a question, but
Hi,
just
Frank.
hi, Peter. Just a really quick to let people know, I'm in the process of purchasing a rental single-family home, and I like to apply for 2 mortgages from 2 different companies at the same time when I buy these properties. And in one mortgage, the interest rate came back at 7.75%, and the other company came back at 4.1%. So dramatically different. And I've never had that happen before. Usually, the 2 mortgage companies will come back 0.5% different, or a quarter or something. But in this case, 4.1% from one mortgage lender and 7.75, 7-year, both of them 7-year fixed mortgages, and just both way different from the 5.5 you were talking about. Extremely higher and lower than that. So it's quite a unsettled time. You know, things are in flux.
Thank you. It's interesting.
Yeah, well, and
That
Frank,
is
you also have to.
fascinating.
Oh, sorry. Go ahead, Peter.
Go ahead, Dave.
I was just going to say,
No.
you mentioned it was non-owner, so that's really going to change things. So when you're saying comparing, what we're comparing is a single family primary residence.
Of course.
I mean, that's where we're in the 5%
But I got
range.
I understand, but I got a 4.1% interest rate for a non-owner occupied, as well as a 7.75% quotation. So it's,
Yeah, and
That
you
is
got
really hard to believe. I think they made a mistake. They don't know that you're renting. I had higher rates than that 2 years ago.
yeah. No, I mean, it's just, you also want to vet them, make sure that you've got, you know, loan estimates up front that you can look and compare them side by side. Just as long as it's not a quote, then I think it's valuable and you can rely on it.
And I guess when markets are in flux, some are going to be reacting faster and there's going to be more disjointedness out there. And rather than everything being the different competitors being able to look at each other and, you know, the market settling in at a price. So maybe
Yes,
shopping
exactly.
around or getting professional help is, yeah, chaos is chaos.
yes,
But
exactly.
that's almost a doubling,
Yeah.
Frank. That's amazing.
Yes.
So much for efficient markets. Well, we went a little bit over because I thought that was a valuable discussion. Really appreciate those questions. And I would love to go on, but we have, you know, we all have places to go, things to do. Please feel free to contact Dave or me if you have any questions about any of this. I'm glad we could make this an educational event today. We're not selling anything in particular, just giving you information. And good luck to all of us in the time of change, but this could become a good time for savers. When if rates get high enough, savers may start to be able to take advantage of that. Any last words, Dave?
No, just thank you, Peter, so much for putting this together and for having me. Really appreciate it.
It's always good to have those specialists. Money is a very broad topic, and we really appreciate your expertise and look forward to working with you. So again, peter.johnson@pwjohnson.com for copies of slides or questions you have. And you've got Dave's stuff up there. And I'll turn this into a PDF document and send it to you, Dave. So we're all set.
Perfect.
Thanks, everybody. Appreciate your time today.
Thank you.
Thank you, Peter.
Thank
Yeah, thank you.
Great. Thank you very much.
Thank you.